After a series of baby steps, to be precise, 8 25 basis point hikes between March 2010 and March 2011, Reserve Bank of India Governor D. Subba Rao has finally taken a giant stride, 50 basis point hike in Indian Central Bank's policy rate. I am not surprised. In fact, some of us have been pushing for a 50 basis point hike because inflation was fast going out of hand. And Reserve Bank of India has recognized that, and it has made it very clear in the short run the growth can wait, but the immediate task of the central bank is to fight inflation, and the only way to fight it, upping your rate. So that's point number one. Growth can wait. There will be a slowdown. In fact, RBI's projection of growth is about 8%, which is 1 percentage point less than the Finance Ministry's projection. I'm not very sure when did we see last time this kind of divergence, 1 percentage point gap. Does this mean the Reserve Bank of India has reached the end of the credit tightening cycle? I mean the rate tightening cycle? I'm not very sure. I think there is at least 125 basis point, if not 50 basis point hike we can see in phases over the next few months, because RBI's inflation projection is not too good, about 9% till December and 6% by the year end. As all of us know that RBI has failed in its inflation projection twice in the past year. Another critical takeaway from this year's policy is 50 basis point hikes in savings rate after 19 years. So it's good news for consumer. They are seeing the real value of their money kept in saving banks getting eroded because of high inflation. Now they will get little more. But it's bad news for banks because their cost of funds will go up. Their NIM, net interest margin, or the money they earn on advances and the money they pay on deposits will shrink. Their profitability will be hard. So there's a huge implication for banks' profitability and balance sheets. There is yet another interesting aspect of the policy is this: RBI has accepted most of the recommendations of Maligram panel, and it's ready to regulate India's microfinance industry. Now, and it has made it very clear, unless the microfinance institutions accept all the norms like not more than 26% lending rate, so on and so forth, they will not be able to access bank money. That I would think that would lead to a consolidation in the microfinance industry. Many smaller microfinance institutions, and there are too many across India, they may not survive, and we might see consolidation.